Good afternoon, everyone. Today I'm chatting with Andy Schectman from Miles Franklin. In today's interview, we discuss the current capital environment for precious metals and what all of the money printing done by the Federal Reserve Bank has meant for precious metals, as well as the idea that Judy Sheldon has indicated that the U.S. may at some point introduce 50-year bonds backed by gold at what Andy thinks could be 0% interest rates. So Andy walks us through why he thinks it's such a bullish time for precious metals. And guys, if you're bullish on gold or silver, this is an interview you're going to want to watch. All right, everybody, enjoy the conversation. Andy, thanks for hopping on again.
Good to be here, Steve. Good to see you, brother. Thanks for having me.
So I'm sure that the last year has been an exciting year for you, a pretty big precious metals dealer who is in what has been, for the most part, a raging bull market. Something I say to various people who ask me about the business I work in, which is primarily on the equity side of mining, is that Donald Trump has been good for precious metals. You think that that's a fair assessment?
Yeah, I mean, look, we've become net importers of gold since November. And, there's no coincidence that's when he won the election. The amount of interest that we've seen on all levels, precious metals, since November, and the crumbs that have been left along the way from people such as Donald Trump himself, Treasury Secretary Bessent, Judy Shelton. I mean, on Easter Sunday, Trump says by tweet, he who has the gold makes the rules, the golden art of negotiating. That comes after massive imports since November. In 35 years, I've never seen that, ever, never. Maybe 1 month here, 1 month there, but now month over month, we're seeing massive inflows into the COMEX. We're seeing the draining of the exchanges and the LBMA and the COMEX. And then you're seeing all sorts of rhetoric that would lead one to believe that things are different this time. And but the interesting thing about it, when you take a step back and you look at the macro picture, Steve, what you see is something that I think really screams to the contrarian in me. And that is that since the beginning of the year, we've seen massive selling in equities by the insiders, the institutionals, the insiders. We just saw Jeff Bezos sell another 5.7 billion in Amazon stock. You got Warren Buffett sitting on 500 billion in cash and treasuries. You have Jamie Dimon selling. You have Zuckerberg selling. You have all of the insiders selling. Since June, the institutionals have been selling on average 2 billion per week. You had the top 3 largest shareholders and board members of NVIDIA dumping hundreds of millions worth of stock. Now, this is at a time when the insiders are all leaving and the retail public, the mom and pa, have a larger exposure to the equity market than ever before, ever, including higher than the dot-com bubble at about 53, 54% of all stock ownership is owned by the retail public. At the same time, you're seeing the public really not have much exposure at all to metals on this level. And in fact, Rick Rule often says 0.5%. That's probably being generous. While you're seeing the exchanges being bled dry. Now, to take possession of what amounts to, or to have delivered at what amounts to over 100 billion in gold and silver, 100 billion since the beginning of the year that we know of. A lot of central banks are now admitting to buying privately from local and artisanal miners, not doing it through the normal channels that would get cataloged, like through the COMEX or through import-export numbers coming out of London or Switzerland, but that we know of 100 billion. So the insiders are going deep, deep, deep into physical commodities and actually taking possession, pulling them off of the exchanges, while the public is going the opposite direction. So you have massive influx in metals by the insiders and leaving the equities by the insiders. It's the polar opposite by the retail public. What could possibly go wrong? Yeah, I think you're looking at a setup for a very big second half of the year, and I would expect the fall to, I think, show that. The insiders don't take possession in May of 8.5 billion in gold off of COMEX. This is 1 month that we know of, without it being something that they've given a lot of thought to and probably know the playbook. because at that level, those people just don't have the most money. But to take possession of that kind of, or even just to deliver that kind of volume into COMEX is incredibly sophisticated, and it's not something easy to do. You'd be far easier to for someone to give me $500 million and have me go out and scour the world and get them gold bars and stuff than it would be to take possession of metal. Now you're talking 100 billion off COMEX. So something deep is going on, and I would expect that to translate at some point into the retail side, as they're always late. The public is always late after the insider's position. I think that's where we're going. So I'd say buckle up
So
for the second half of the year.
just let me repeat what you're saying as I understand it for our audience. You're saying that you think that we've got some of the largest investors in the world on the equity side starting to sell off some of their equity and position themselves in precious metals.
Whether or not they're positioning in precious metals, the same people that are selling equities, what I would say is that the big money is leaving the risk of the equity market, which is trading at all-time highs, and really disconnected from the economy. At the same time, the public is going all in on equities when the insiders are leaving. And then at the same time, big sophisticated money is delivering more gold and silver into COMEX than we've ever seen ever in the history of the exchange. Ever. Month over month over month over month over month, we become net importers. These are very sophisticated, institutional, in the know buyers, and the public has virtually no exposure at all. So whether they're the same people doing it, probably are, or not, I guess I would just simply say the sophisticated traders are leaving equities and buying commodities. It's the polar opposite for the public.
Andy, something that I think a lot about, as you know, I'm 42 years old. I'm constantly watching different media of other people that are kind of young, working age. But a lot of the stuff that I stumble across is AI related, and those solutions that are starting to come to the forefront. And when I look at AI, I think, it's the ChatGPT changed the game. Obviously, it's really just a large language model. It's not necessarily the greatest at critical thinking and logical reasoning, but it's getting there. It's getting. For example, we had one company who announced a large royal and streaming deal, and we were trying to understand the terms of the deal, and we were reading through it and kind of trying to do the math. And then I just said to chat gpt, I'm like, here's 5 different scenarios, tell me what the royalty stream looks like, and it just instantly did the math for me in like 10 seconds. So like, there is some good stuff happening there, but really the point that I'm trying to get at is when I think, 3 to 5 years from now, where AI is going to sit and the impact that that's going to have on jobs and on economics and on unemployment, and how we expect governments to react to that in the same way that they always do. It almost starts to make me think this idea of just like standard productive businesses, is that going to hollow out, and then there's going to be more money in the system, and it's going to have to chase something. And I feel like we're just creating a tidal wave of capital that's going to flow in the precious metals, just because it's not really going to have a whole lot of other places it can go.
Yeah, I don't know. I don't know how much capital is going to flow into the system in the respect that it's going to hollow out the industrial base of many industries. I mean, you're talking
Yeah.
so many jobs will be replaced by AI. What you will have certainly is a separation of wealth. I mean, you'll have a very large group of people who are very wealthy, and unless we bring back our manufacturing, which I do think they're attempting to do, which is kind of my thesis on everything that's happening right now, which it'll be a period of serious, I think, stress and pain. But you wonder, yes, it will make corporations perhaps more competitive and more have a sharper bottom line. But what does it do to all the people that had high-paying jobs? For example, my son, who now works at Miles Franklin, we wanted his mom and I, to find his way in this world before he came and worked for dad's company. And so he became an accountant out of college at Price Waterhouse in New York City, getting paid 75,000 a year, barely making ends meet. Without my help, he would have starved to death living in Manhattan at that rate. But
You can't really live in New York City off $75,000 a year, can you?
that's where they started him. But the point is, he was analyzing real estate investment trust balance sheet. Now, what do they need to pay a kid 75 grand with, health insurance and bonuses and whatnot to analyze a balance sheet that ChatGPT and their new accounting software can do like that? They
Yep.
don't. And I mean, the list goes on and on and on and on in so many different fields where do these people go? Now, when you realize at the same time that um, United States, roughly 60% of the country doesn't have a college degree, and you begin to replace jobs, menial jobs, that could have otherwise been done by people, it becomes very scary. You look at like, for example, who needs a stock analyst when you can have ChatGPT do it and present it to the handful of senior financial advisors? Who needs a law clerk helping a judge or a high level attorney researching case law when ChatGPT can bang like that? So I mean, you can keep going on and on and on. So I don't know how that plays out, to be honest with you.
I saw a fantastic example yesterday, and I'm sorry, I didn't want to steer this conversation too far into AI, but I saw a great video yesterday of a guy who is an HVAC repairman, and he said everybody thinks, oh, you should go into HVAC, you're going to be safe. And he was wearing a pair of they might have been Google glasses or the Meta Ray-Ban glasses,
Yep.
and he's
Yep.
like, today I was working with a system I had never seen before because it's got all this technology. The glasses were able to read it and tell me what exactly was wrong with it, and I was able to fix it in 5 minutes.
Right.
And
And that's the
so
problem.
it's
So
all it's all
it will increase productivity, but at what expense? And I think it's going to be an interesting deal, but I don't know that it creates that much more to the bottom line for the whole ecosystem. It just makes the people at the top probably wealthier. Just thinking off the top of my head, but who
but
knows?
but
These
but
what if questions
but
are hard.
when we think about these scenarios, though, typically how this always works out is governments just end up printing more money, running larger deficits, and then we have more money in the system. And my assumption here is that that's going to be tremendously bullish for precious metals.
Yeah, there's no question. I believe they're going to destroy the dollar. I think that's what they're intending to do to save the system. Now, how do they do that? I think ultimately you see the stablecoin bill that is being used to flood the front end of the bond market with short-term debt issuance, which when Janet Yellen did it, we saw how beneficial that was for metals and for equities and for cryptocurrencies. And as Luke Groman, I think, aptly puts it, they want to anesthetize the back end of the market. And here is the thing. When you look at where we're at the back end of the market, the 10-year treasury, you're going to see rates continue to move higher because just bottling up a few facts, we have $28 trillion due in 3 years in maturing treasuries. That's fact. 28 trillion by 2028. We take in 5 trillion a year in tax revenue. That's 15 trillion. You're halfway there. That doesn't take into account the 3 trillion plus per year in deficit spending. They just came out with their projection for the next quarter. They want to print $1 trillion over 3 months. So the point of it is that 3 trillion per year deficit spending minimum over the next 3 years is another 9 trillion. 28 and 9, 37. We take in 15 trillion in tax revenue. We're, hardly 25% of the way there, basically. So how do you do that? How do you finance that at a time when the rest of the world is shedding treasuries like China and Japan and Saudi Arabia? And now we're supposed to believe that the United Kingdom, one of the most indebted nations in the world, is buying the debt of the most indebted nation of the world. They're number two, and the Cayman Islands and Ireland. The whole thing is a shell game. So what I believe that they are going to do is first and foremost, let's look at we've become a net importer of gold. And month over month, we're seeing massive inflows of gold every single month. I asked Judy Shelton, who was Trump's nominee to run the Fed in 2016, um, you know, Do you think that they're going to issue gold-backed treasuries? That was what her book was all about. On my interview with her, she said there is no question, in no uncertain terms, did he say to me, July 4th, 2026, he will do that. It's a big day for him. It's the 250th year anniversary of the country, and he will issue gold-backed treasuries on the back end of the market that day. Now think about this. If you are reshoring all the gold, you let the price rise, 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 rise. Even Luke Groman thinks it'll get to 4, 5, 6, 7,000, and then they'll revalue it. Now, gold is held on every central bank balance sheet in what's called the gold revaluation account. You can't make it up. That's the name of it. If they did revalue it, first of all, it would benefit every central bank on the planet. The Treasury only needs to tell the Federal Reserve, revalue the price of gold right now. And they do. Bang, it's done. No congressional approval. Every $4,000 increase in the price of gold would give the Treasury General account $1 trillion free and clear. If they moved it, as Jim Rickards says, to $24,000 an ounce, as crazy as that sounds, it would benefit all the central banks. It would massively devalue the dollar, to your point, create tons of inflation, but now that would give the Treasury General account $6 trillion free and clear. The Treasury issues gold certificates to the Federal Reserve. The Federal Reserve takes the gold and holds it. Prints the money, the $6 trillion, which devalues the dollar tremendously, just like Roosevelt did in 33, gives the money to the Treasury. Now, the Fed doesn't own that gold. They own the dollar value of the gold. The gold belongs to the Treasury and to the American people. Now they start paying down their debt. They don't have to issue any long-term treasury. They flood the market with stablecoin issuance on all the cryptos that fund the short-term treasury debt to keep the game going. And with low interest rates, if you back the treasury, the long end, like the 50-year to start with, as Judy says, and then 30 and 20 and 10 later, shorter durations over time, you can peg a zero interest rate to the long end of the curve. Zero interest rate, zero coupon, redeemable in gold. That gold is the inflation barometer. The more stupidity we use in monetary policy, the higher the price of gold goes. So we say, take our long-term treasury. You can still trade it the way you always do, giving you great liquidity, but it is redeemable in the end in gold. Judy Shelton says they'll issue stable coins off of those too, giving more energy to the short front end of the curve. And now you have zero interest rates on the long end, redeemable in gold way down the road, starting at 50, 30, and then 20 and 10 over time. But now you can bring back your manufacturing in an era of a very devalued dollar and very low interest rates on the long end. Bring back your manufacturing, reshore your manufacturing, and grow your way out of this mess that we find ourselves in. It is, in my mind, the only way out. You can hyperinflate, you can default, or you can do a soft default on the dollar, which I think they're going to do. They're going to destroy it. You save in dollars, you're going to go broke, period. So they will print their way out of this problem to print the $37 trillion in debt in 3 years, but they will peg the Treasury to gold, probably revalue it, which devalues the dollar, allows them to pay off the debt, some of it, and not issue long-term debt for a couple of years anyway, with all the money they take in from the Fed on the Treasury General account issuance of gold certificates. With those low interest rates and cheap dollar, you bring back your manufacturing, you retool, and you grow your way out of this problem. And I could see Trump getting in front of the American public and saying, listen, we've squandered this wonderful opportunity. And by the way, they understand it. It's called Triffin's Dilemma. Vice President Vance has talked about this, written about it on White House letterhead, that if you are the world reserve currency, Triffin's Dilemma says you will always have a trade imbalance, a big one, because you cannot give the world enough dollars to do everything they need to do with the world reserve currency simply by trade alone. You export dollars to the rest of the world, which means they sell their currency to buy your currency. Their currency goes down, your dollar goes up, meaning manufacturing over there is half the price, let alone the labor side. So your manufacturing gets hollowed out. There is no way to be a world reserve without hollowed out manufacturing. So all the manufacturing goes over there, and that's where we are now. Coupled with the indebtedness and the fact that we've held interest rates so low for so long, so many years, that we created distortions in asset prices, there is no way to bring it back without blowing up the entire system. Either you hyperinflate or you let rates go to the moon in stocks, bonds, real estate, banks, insurance companies, poof, all at once. So how do you keep rates low in an inflationary environment and still get demand for the long end of the curve? The short end, they will create these stable coins, which is really not stable if you think about it. A coin that is backed by debt and more debt and more coins and more debt and more coins. And it's a shell game on the front end for a while. But if we have the ability to drop rates down to zero because of redeemability in gold and bring it back, you have a fighting chance to grow your way out of this problem. You truly do. Inflation will not be solved by letting rates go higher. You'll destroy the system. Inflation would only be resolved in this environment by growing your way out. And we ain't going to do that until we bring back our manufacturing. And we ain't going to bring back manufacturing at 5, 6, 7, 8, 9% interest rates. At zero and a very devalued dollar, yeah, you could. Honest to God, I believe that's what the plan is. So yeah, you save in dollars, you're destined to go broke. You're not a contrarian, you're going to be a victim. And that I do believe, 100%.
I agree with a lot of what you're saying. It's there's clearly problems that I think guys like us, when we go to cocktail parties with just normal people, they often, you know, they don't know what's happening in the world. They don't really care. They just
I don't talk
assume that
about it either
government
because
should.
you'll never get invited back if you start talking this shit with your friends at a cocktail party.
Yeah, and that's I think that it's challenging too for me, even when I talk to friends from Toronto that are, the issues that they care about when it comes to politics are things that to me are just trivial and like the big picture. Guys like us, we care about, I think, economics first and foremost of how can we increase our standard of living, and that's ultimately kind of what we look to our government to be responsible for. But I that being said, I mean, what Trump's trying to accomplish is, I don't know if it's something that you can actually accomplish in 4 years because it's going to require a fair bit of short-term pain. He's got a gigantic media establishment against him, whether what he does is smart or idiotic. And let's face it, with Trump, there is a little bit of both. Do you really think that he will get the rope to actually accomplish what he started here?
Well, I hope so, to be honest with you. It's our last shot. I'll tell you one thing, if Kamala Harris was president, this country would be completely and totally toast by now. It's our last shot to get back what this great country stood for. And we used to be the engine of innovation and manufacturing. We used to be revered. We used to not fight wars all around the world. We used to have a trade surplus. We used to be the envy of everyone, wanted our stocks that were at all-time highs in 1999 with a trade surplus. Since then, we have the largest debt in the history of civilization at almost 200 trillion when you factor in Medicaid, Medicare, Social Security, and government military pensions, which are all off balance sheet, which amount to about 175 trillion or more. A trillion seconds ago was 31,688 years ago. That's a trillion seconds. We are screwed to the nth degree if we don't do something. We are at the end of the rope. My mentor, Richard Russell, used to say that the Fed has two choices: inflate or default, period. Inflate or die. They were that far down the road at that point. This was 15 years ago. Well, now I believe they found a third solution, and that is a soft default on the dollar. Give up on it because we have become so indebted. And bring back manufacturing. We cannot have our critical manufacturing for pharmaceuticals and microchips and aircraft and weaponry parts and all of this stuff that we're getting from all around the world. You know, you look at this new thing that Trump wants to do as an example. I mean, it's a very challenge. It's not easy. He wants to, in essence, print money through stablecoin issuance and through the Treasury and then reinvest in our infrastructure. Well, as the world reserve currency, can you really do that? Can you really print money to invest in your own country and then try and sell your products to the rest of the world who you expect to buy your treasuries? If I were those countries, no, I'm not buying your treasury. Absolutely not. Why would I? And so this is a situation where it's going to be hard no matter who's in office. But if you don't attempt to do this, ultimately, we end up at a situation where the rest of the world no longer wants to hold our dollars or our treasuries, and they dump them. And that's the great reset right there, because the 30 years of suppressed interest rates have created distortions in asset prices, misallocations of capital and resources. And so as rates spike, because people dump dollars in treasuries because they're sick and tired of the way we've mismanaged the world reserve currency, the weaponization of the dollar, the wars that we're participating or funding in all around the world, et cetera. And when that tsunami of dollars and treasuries hit our shore, it results in hyperinflation. To compensate for the massive spike in inflation, rates have to go to the moon, which would blow up everything: stocks, bonds, real estate. The banks and the insurance companies are all loaded with treasuries. It is the Great Reset. So short of that happening, you more or less soft default on the value of the dollar in order to peg the long end of the treasury in gold. You got the front end of the treasury covered with stable coins. That's why they're doing it. It's not because they're all into crypto. It's because that they need to get demand, that for that vacuum of vanishing demand that we see all around the world right now, where countries aren't buying treasuries anymore. And you keep rates low enough, you may have a shot at bringing back your manufacturing. You go away from that plan, there is no out. There is no option. We will never pay off our debt otherwise, never. We don't make anything anymore. We don't manufacture anything anymore. So is AI enough to do it? Hell no, it's not, because the rest of the world is doing AI too. And so I think we've squandered a beautiful opportunity, and what once was a privilege to be the world reserve currency is now more of a problem, because we continue to hollow out and eviscerate our manufacturing with the world reserve currency status. China doesn't want to be the world reserve currency. They don't want to do that because they'll hollow out their manufacturing too. Instead, I believe gold will be the de facto reserve. It will act as the treasury. And you are seeing all sorts of things going on right now where countries are trading their own central bank digital currencies, in particular over the BRICS bridge that has now been expanded to non-BRICS nations, and settling imbalances in gold. I believe that is the framework, whether it be backing the treasury and redeemability, or the way that the BRICS have spoken of in their unit token, and the way they're doing it right now with the expansion of the Shanghai Gold Exchange to other locations throughout the Belt Road. Redeemability will be in gold. That is not replacing the currency, but it's replacing what stands behind the currency. And it's the trust that we have squandered through weaponization, in particular against Russia, where much of the world thinks we're no better than they are. We invaded Iraq 22 years ago, and we're still there. And we went there for weapons of mass destruction. Sorry, we didn't find it. I know we blew everything up, toppled your regime, but hey, sorry. Well, why do we not face the similar repercussions that someone like Russia did? We made the decision as the world reserve currency to be judge, jury, and executioner. I'm not paying any, passing any judgment on any war. I'm just simply saying, as the world reserve currency, it is not the prerogative of the issuer to make those kind of decisions, especially when many would say our actions are just as provocative as others or more. And so that puts trust into a system that's all about trust. It's not backed by anything anymore but trust, the full faith and credit. What credit? We're broke, we're insolvent. The faith? What faith? We take 5 billion of Russian forex reserves and kick them out of SWIFT because they're doing what they believe they need to do. But when we do it, there is no repercussions. That's pissed off the world, in a line you can't come back from unless you do something very drastic. And I think that's where we are right now, drastic measures, because short of that, I have no idea how you pay off 28 trillion just in maturing treasuries. Forget about everything else. In 3 years, with 15 trillion in tax revenue and a 3 trillion per year to boot trade deficit or more, you're talking 25% of the way there. And then what? So you have to start thinking outside the box right now, and I think that's what this is.
There, there was a quote recently from Tucker Carlson, and I don't know if you saw it, but it just kind of resonated with me, where he talked about how GDP is kind of this, just like, when you really think about it, it's kind of this bizarre metric for actually measuring the productive um, output of a country, because it's so easily manipulated, right? Like, you run bigger deficits, you have more GDP, and it's also priced in whatever your local currency is. So sometimes that's not always something that's reasonable. For example, like an MRI in the US costs maybe like 100 times more than it costs in China. So one contributes a lot more to GDP than the other. But Tucker Carlson's point was, he thinks that you should actually look at the standard of living of a country based on whether young people can afford to buy a home or not, of which America's basically face planted. And I'm curious what your thoughts are on that. If that's just sort of like when we look at GDP, it's like they're just doing everything they can to prop it up. And when you talk about the misallocation of capital that we've seen, if that's just all just basically a byproduct of too much money in the system and governments just having access to basically do whatever they want with a single journal entry.
Yeah, I mean, you could argue that GDP is fugazi in that respect, and not to mention our indebtedness right now is 120+% of debt to GDP. If you add in the off balance sheet, we're well over 200%, and there's never been a country that's crossed 130 and come back without hyperinflating or defaulting. We're right there, and we're over it if you take our off balance sheet obligations, Medicare, Medicaid, Social Security, government military pensions, and the like. But you're right. What has happened is that through suppression of interest rates, you created these distortions in asset prices like homes. And what happened with the residential real estate is that you drop interest rates on the federal funds rate to zero. You have 3% mortgages. And unlike where you are in Canada, we can lock that in for 30 years, not 5-year re-amortized in Canada, which makes it a little bit more difficult. So you get people that, you know, 6-7 years ago, well, like shit, the interest rates are at zero. I can get a 30-year mortgage for 3%. And well, we can buy a bigger house and we can do all of these things. So they lock in at 3% and their rate is relatively low. That's great until you lose your job. And so the lower rates made prices go higher and higher and higher because more people could afford more and more and more. And so what you have now is a situation where people are trapped. They're locked into their mortgages. They can't carry their mortgage with them. If they sell their house, the cost of lending now is up over double, 2.5 times at 7% on a 30-year mortgage. So now you can't even move laterally. You can't take that rate with you. And no one wants to lower the price of their house. So you have younger people who have to pay a much higher price with much tougher lending standards, which with much higher rates. But guess what? If you just would have kept your money in gold instead of dollars, it'd be easy, right? Because in 2005, the average price of a house was, I just was looking at this the other day, 2005, it took about, let me just make sure I'm right on this. I think I am. 800 times. Yeah, take about 800 ounces of gold to buy a house in 2005 with gold right around, call it $400 an ounce. 800 times 400 is $320,000. So let's just say that you sold your house in 2005 for 320,000 bucks and you kept the proceeds in gold since '05. And I can go back to 1960 and draw the same analogy, by the way, which I'm happy to do for you after here. But you decide put it in gold. Everyone says you're a fool. Don't do it. There's better places to put it. Well, you put it in gold and you leave it there because gold has smoked the real estate market since '05 and go back even further. But the point of it is that those 800 ounces today at $3,400 is $2.5 million or more, whereas almost 3 million. Is that right? 800 times 3,400, $2,700,000. Right? That $320,000 doesn't even buy you a house right now. As the average price is over 400,000. The point of it is the dollar is losing value against things like real estate. Saving in dollars, you're destined to go broke. You put it in gold, well, it doesn't earn any interest. Who gives a crap? It keeps pace with inflation. Go back to 1960 and do the same thing. The price of gold was 35 bucks an ounce. The Census Bureau will tell you a house was $17,000 in 1960. Do the math. $17,000 divided by 35 is 485 ounces. So your great grandparents, I go, Grandma and Grandpa left us 485 ounces of gold. Should we just pay for the house? Or should we take out a $17,000 mortgage? They said, you know what, let's take out a mortgage. We have put 485 ounces under their mattress for the last 64 years, earning nothing but dust. And that $17,000, well, that wouldn't even buy you, all your furniture. It wouldn't even buy you a TV and a living room set and a dining room table. But the 485 ounces of gold, well, let's see, what's that worth? Times 3,400. $1,650,000. The average price of a house today, call it 400,000, it buys you 4 houses. So when you talk about what gold does, it is it's you don't buy it to become wealthy. You buy it because it is wealth and because it retains your purchasing power, no matter how you look at it and how far back you go. And you're right. The reason people can't afford houses right now is they've destroyed the value of the dollar, period. And by messing with Mother Nature, by suppressing interest rates, you create massive distortions in economic realities, in asset prices. We don't know what real asset prices are. What is a house worth? I bought a house down here in Florida and I got it in the middle of COVID and I stole it, I think. But at 3% mortgage, it's worth X. What's it worth at 7? What's it worth at 10? How many people can buy it at 3? How many people can buy it at 7? How many people can buy it at 10? At 10, your mortgage is 3.5 times higher than it is at 3. So who can do that? So the point of it is that they suppress interest rates. Interest rates should be a function of the market, not by a bunch of fat bankers who decide what the rates should be, 12 regional bankers that are detached from reality. So yeah, I think Tucker is right. And it isn't about GDP as much as it is the bigger picture. GDP is all of the statistics that come out of the BLS, which should just be the BS bullshit instead of the Bureau of Labor Statistics, they're all massaged and directed towards painting a picture, making the dollar seem stronger than it is, make inflation seem lower than it is. All of these things make unemployment seem better. They say inflation is under 3%, yet John Williams of Shadow Stats just uses the numbers the way they used to be calculated during the Carter and Reagan administration before they were changed. He says add an 11 to that. You have 12 or 13 or 14% inflation, not the 2 or 3 that we're being told. So all of these things function or factor into that point. So yeah, this is probably the most difficult time it's ever been for young people to want to buy a home because of higher interest rates, because of asset prices that are skewed. And now you add into it AI and the more challenging labor market. It's only going to get worse before it gets better, in my opinion.
And look, you've been generous with your time here, and I won't take up much more of it. But there's one anecdote that I just have to talk about, and I just wanted to bring up where I think about this misallocation of capital that governments have created with these deficits. And one local example here in Canada is we have our federal post service called Canada Post, and it's they're technically not supposed to be losing money, but lately they're basically on their way to not being able to make money because everybody who works for Canada Post, they feel like they're entitled to make $70,000 to $130,000 a year kind of thing, nice pension, great benefits. And the problem is that when Amazon came to Canada, they started employing all these small little services that do parcel delivery, and they can do it for literally 1/3 the price of Canada Post. Can do it. And the point that I'm getting at here is that the government ended up bailing out Canada Post so that a bunch of workers could have these jobs where they make 3 times more than the people who work for Amazon and the parcel services that Amazon uses. And there's literally no difference between the two. There's none. It's like it's like we might as well have just let Canada Post die and then pick a random like 12,000 people in Canada, picked them via lottery and just handed them huge payments
That's
because
the whole that's
it and it just gets back to this whole misallocation of capital that you've talked about. And this is what governments have done to us.
Yeah, well, that's the whole. I mean, you can sum that up in 2 words: profit motive. When you have one group that has no profit motive, they don't give a shit, and they want more, and they'll work less, and you know, and I don't mean to throw this at Canada, but you could say that's kind of the issue of socialism. Everyone, when you have a profit motive, capitalism, you want to make money, you bust your ass, you be better, you have ingenuity, you provide a better service for less cost. That's what happens when government gets involved. They don't have the profit motive, and so there isn't the level of ingenuity. There isn't the level of bust ass. There isn't the level of I want to produce something better for less because I want to earn market share. Well, no, I don't care. I want my pension, and the government's going to give it to me. So I just want to work 9 to 5, and when that whistle blows, I'm gone. I stayed at work here last night till 8:30 at night on my last podcast, got here at 8:30 in the morning. I spent 12 hours here. Now, that's because I own a company and I want my company to do well and I work very hard. But if I'm working for a government position, well, the minute it's 5 o'clock, I'm out and I'm not staying. I'll do it the next day. Point of it is that, to your point, that when you look at all of the misallocations and of resources and capital, they aren't just related to interest rates. They're also related to a growing bureaucracy, a growing government that doesn't have the same motivation that the private sector does. So in any area, whether it be healthcare, whether it be um, you know mail delivery, or whether it be the government's intervention in anything, you'll find that the private sector with profit motive will always outperform the government simply because they want to succeed through hard work, ingenuity, initiative, and cost savings. That's not a priority of the US government or the Canadian government or any big government. And it's a good point to add to misallocations in decision making by big governments, along with misallocations in monetary policy and brain dead, reckless, silly fiscal policy. You put it all together, it will never compete with the free market enterprise. This is why capitalism is a beautiful thing. Free market capitalism says he or she who works hardest, has the greatest amount of ingenuity and elbow grease, and able to produce the best product at the lowest cost with the biggest smile on their face wins. And that's why Amazon is where they are, and that's why Canada Post is where they are, and that'll never change. It'll only get worse.
And the unfortunate part of it is that in the short run, you can have these blips where it makes more sense to be working for the government. So, like if you've lived in Canada over the last 25 years, your best ticket was to just go get a government job and invest in real estate, and you could have walked away extremely wealthy from that. But the problem is that it's at some point, like enough is enough. You can't. That's not a sustainable model. And then, like, you talk about how America's seen its manufacturing based hollowed out. Well, here in Canada, especially with the tariffs Trump's put in, it's going to be devastating to think of what Canada is going to look like in 5 years with the 50% tariffs on steel and aluminum, and who knows what's going to happen to our auto industry. There might not be a Canadian auto industry in 5 years. And we've basically bet our whole future on government spending and real estate speculation. And we've brought in massive amounts of immigration that even conflate the economics even worse. So,
And you know what the
anyways,
ironic part of all of that is, Steve, is that you guys have one of the largest deposits of natural resources on the planet, from gold and silver and oil and lumber, and bordered by 3 oceans and all this stuff. Um, it's silly. And it's silly that it would be, your futures would be mortgaged on government edict, which, I don't have to say anything about Trudeau and let alone the new administration, but and real estate speculation at a period of time of interest rate suppression. How could that possibly end up poorly? And I think that you're seeing that now. And at the same time, if you just wouldn't have sold all of the gold, and in fact, maybe even nationalize the mines and pull all the minerals out and the oil and enrich the country's treasury simply through doing things like that and building the infrastructure, probably would have been a whole lot better off. But hopefully someday we have a reworking of thinking in both of our countries. Maybe that's what Trump is trying to do right now. I don't know. But what I do know is that we've all gone down a path so far that if these types of very these decisions that would be considered, let's just say, not mainstream, that would be considered a little bit outside the box, I think that's all that's left. Otherwise, I think we're in big trouble. Just, it's about math at this point. It's mathematics. And math always has a way of catching you in the end, just like Father Time.
and that just comes back to that point of why it's so frustrating to have these conversations with people. Like half the people I talk to in Canada, they want to talk more about the truckers and whether they're on the side of the truckers or against the truckers, which was just a bunch of people camping out, having bouncy castles and blowing out horns around a bunch of government buildings. But to me, I find the whole conversation just completely irrelevant in the grand scheme of things, where all I can think about is how this country is heading to a point where the standard of living is going to look like absolute. I don't know what it's going to look like in 10 years, but I already can see it now. We got the local fair here in Toronto, which is the CNE. Back in 2021, I think that there was like 18,000 people applied for part-time work there. This year they've had 54,000 applicants. And like
Yeah,
that's just over 3 years. And
right.
like it tells you that like we're heading down a really dangerous path. 54,000 people applied to be carnies like for 3 weeks, or like it's only open for like a month.
Well,
It
and
just goes to
what
tell you the kind
happens
of
to
state we're in.
Canada if rates go higher? What happens? And now all these people who are locked into a mortgage that reamortizes every 5 years and rates spike, what happens then? I mean, it's a bloodbath waiting to happen. This is what happens when you distort reality by distorting things like interest rates and having government come in and meddle, and then irresponsible fiscal and monetary policy. These are the reckonings that you have to deal with. So who knows what the future brings, but guys like you who are trying to open people's eyes, God bless you. And I'm happy to contribute any way I can. I'm honored to be here and have a tiny, tiny little piece of what you're doing. Help if, we can help anyone understand, the concept of hard assets. Well, that's great.
We appreciate that. And Andy, our audience always loves when you hop on here. Just if I can give you a plug here, if our audience wants more of your commentary, where can they go to?
We just hired Michelle McCory. She's now going to be running our YouTube channel along with me. She used to run Kitco. Our website, our YouTube channel is Miles Franklin Media. They can go to our website, milesfranklin.com. We have a big presence in Canada with storage facilities in Toronto, Montreal, and Vancouver. And one of my dear friends, in a collaboration, I send people to his site, MF as in Miles Franklin, mfbullion.ca. The prices ought to be better than any of the Canadian sites, and that's, you can pay in Canadian dollars. For people in the United States, send us an email at info at milesfranklin.com to request our special price list here in dollars, which will be as good or better than anyone in North America. Info at milesfranklin.com. And I'm happy to come back on whenever you have me, Steve. Sorry it's been hard to connect. It's been a very busy time for me building our new studio and all sorts of changes going on at Miles Franklin, but all good. And I look forward to picking up where we left off, hopefully not too far down the road. Do it again.
Thanks so much for doing this, Andy.
Stay well, brother.
All right, everybody. Thank you for watching. If you enjoyed this interview, do me a favor, smash that like button, subscribe, and ring that notification bell. Also, if you want more mining content, check out our website over at TheDeepDive.ca. All right, everybody. Thanks for watching.